Hey, it's Kristi. Let's tackle the topic of student loans and how it affects your mortgage loan application. Hey, it's Kristi. Thank you so much for being here with me on another video. Let's talk today about student loans. There are millions of people walking around with a whole lot of student loan debt. Unfortunately, a lot of our students don't realize what they're signing up for at the time of taking on those loans to get through college, and you don't really know that impact that those payments and that debt load will have on your financial future. So here you are, you've got thousands of dollars, probably tens of thousands of dollars in student loan debt, and you want to buy your home. Perhaps you're done with living with your parents. Maybe you are just ready for home ownership and this next chapter in your life, and you have a question if student loans will stand in your way of getting a mortgage. So let me share with you that at the time of this recording, it is September 2020, and guidelines change all the time. So full disclosure, things change. But as of this recording, we've got a couple of different ways that we can handle student loans for the mortgage loan approval process. So when we're talking about a government-backed loan, so an FHA, VA, or USDA mortgage loan, if your student loans are currently in deferment, we have to take 1% of that outstanding balance and hold that against you as if it's a payment. Let me share with you the why behind this, because otherwise it just won't make sense. You'll say, why does that happen? So the why behind this is your student loans are currently in deferment, but someday they're going to come due as far as a payment. And what we don't want to have happen is that you have to choose between making your student loan payments and making your housing payment. We don't want to stretch you so far that your debt load has you in an uncomfortable place and maybe you can't stay true to those payments every single month. So we know at some point in time, you're going to be responsible for making that repayment. Now, I hear some of you right now saying, well, I am in an income-based repayment. We'll get there in just a moment. So it used to be back in the day that your student loans were in deferment while you were a student and then for 6 months post-graduation. And it's not like that anymore because so many people are struggling right now with the debt loads that comes along with student loans. A lot of people are being blessed with this moment in time that you have an extended period of deferment. Keep in mind that that interest is accruing. What does that mean? It's adding to your loan amount. So you are actually sitting there with a larger loan amount than what you actually started off with, and it's being reported that way as well. When your student loans are in deferment, it's not helping you, it's not hurting you, it's just kind of a neutral on your credit report because there's nothing really to report. Now, here's what happens. I see this all the time. The deferment period ends, and then Navient or SoFi or whoever is your servicer that you pay doesn't really do a great job of letting you know, hey, your payment is due this next month. So what happens? They start notifying you, or you find out the hard way when your student loan is now 120 days past due and your credit score just plummeted. I see that all the time. So why does that happen? A lot of the student loan lenders, they're going off of your email address that you had how many years ago. You guys, I don't use AOL or Yahoo any longer, but I had, right? That was several years ago. So they may not know how to get a hold of you now, and you may have moved enough times that your mail isn't getting forwarded from that previous address. So we have to be really proactive in talking with our creditors and making sure we're getting the proper communication from them because they have our contact information. But it's one of those things, it's out of sight, out of mind, and we just kind of forget it exists. Okay, so I digress a little bit. Let's get back to it. So if it is a government-backed loan, we have to use 1%. So here's an example. You have $50,000 in student loan debt. We actually have to hold $500 against you in your debt to income ratio. So what that means is the carrying cost of the home that you're interested in purchasing. So it's going to be your principal, interest, taxes, and insurance. That makes up your total housing payment, and flood insurance or an HOA, if one of those exists. If you have like a townhouse or condo, would have HOA dues. So all of that together makes up your housing ratio. That's the top ratio. The bottom ratio is anything else that reports on your credit. Personal loans, auto loans, student loans, and credit card minimum balances. So that added with your housing ratio is divided into your gross income. So before any deductions are taken out if you are a W-2 employee. So what does that mean? $500 added to your monthly costs could have you in a position where you no longer qualify for that home. Your housing ratio might just be perfectly fine and in line with what the guidelines are, which is somewhere between 33 and 36% of your gross monthly income. But your total debt to income ratio might be too high now because of this fake payment that we have to calculate in there. So there is an alternative. If we can get you to go with a conventional mortgage instead of an FHA, not everybody qualifies for a conventional mortgage. A lot of first-time home buyers start off with an FHA. It's a little bit more lenient on lower credit scores and late payments. It's kind of okay if you have some collections that had happened out there or charge-offs. If you had a repossession, you're likely getting an FHA approval as opposed to a conventional. Conventional tends to be very conservative. And we also have to have a lower debt to income ratio on a conventional mortgage versus an FHA. So conventional mortgages, if we were to take you, there's two kind of parent investors. There's Fannie Mae and there's Freddie Mac. If we take you with Freddie Mac, we only have to use 0.5% against you if you are in deferment. So that can make a huge difference, right, on your qualification, because that monthly payment is essentially slashed in half as far as what we have to use for your calculations of this fake number. Okay, so let's talk about if you are in an income-based repayment. So you might have a $50,000 student loan repayment, but you might only be paying $28 a month because you've worked something out temporarily with your loan servicer that you pay your student loan debts to. If you are in an income-based repayment, as long as it's greater than zero, we can use that dollar amount if we go Fannie Mae or Freddie Mac. So in other words, any conventional mortgage will allow us to use that income-based repayment. So that's exceptional. So a lot of times if I have potential buyers come to me and they're currently in deferment on their student loans, I'll say, work out an income-based repayment. Get me that piece of paper that shows what your dollar amount is that you're paying every month, and we can now get your credit report updated to reflect that new credit report, that's that new amount that's due. Get that updated on your credit report, and we can use that for qualifications. So in this example, you can see how a $500 payment versus a $28 payment will have all the difference in the world for qualification purposes. So it's a really big deal. Now, guidelines change all the time. At the time that you're watching this video, it might be very different. So make sure that if you're searching information online, that you look at the date of when it was posted, because things change all the time. I don't want you looking at guidelines or rules that were 5 or even 7 years ago, because it changes all the time. But I want you to know, because you have student loans in deferment or in repayment, it should not keep you from being able to apply for a mortgage. It's one of those things I think you should try anyway. And if you want to buy a home, and get some advice from your loan officer, get some guidance on how to handle that, because you might just be told, hey, get an income-based repayment and keep it under X dollars, and we can get you approved for your desired purchase price. Hope this information helps you. Thank you so much for being part of this. And if you haven't already, please subscribe to my channel. And until next time, my friends, stay well.